All right, welcome back to Financial Clarity for Doctors. I'm Corey Janoff, joined as always by Rachelle Vanderzanden.
Hello.
Today, we want to talk about minimizing taxes, or more so, why you want to be cautious about always optimizing for tax minimization or tax avoidance. And sometimes it's okay to pay the going rate for taxes in favor of simplicity or liquidity or not falling for a too good to be true scheme. Now, full disclosure, we are not tax professionals. Do not take anything in this episode as tax advice, but we've come across enough case studies where people go overboard in pursuing tax minimization only to later maybe regret it. Not always, but sometimes. I think that if it sounds too good to be true, it probably is. If it's too complicated to explain, maybe push pause for a second, but maybe let's start with some examples of scenarios. And these aren't necessarily client scenarios, but just friends, colleagues, family members, you name it. Where it's like, all right, that's a good cautionary tale. But we'll kind of walk through some scenarios where tax savings maybe was the tail wagging the dog and made us scratch our heads a little bit. So where do you want to start, Rochelle?
You know what I was actually thinking about when we didn't write down here, but permanent life insurance, I think,
There you
is
go.
one that is frequently like put forward as a good tax saving strategy. And that one's kind of interesting because it can potentially be beneficial for tax planning purposes. So, what happens when you set up a permanent life insurance policy is that you have a chunk of money that's going into the policy to kind of cover the cost of the insurance. So, like if something happens to you and the insurance company needs to pay out that death benefit, let's say it's like a $500,000 policy, they need to kind of cover the risk of that happening. So, there's a part of it that goes to cover that risk. And then you can set it up so that another portion of that goes into like some sort of cash accumulation bucket. So the rest of it may go into this bucket and can grow over time. There's lots of different ways to set this up, like lots and lots of different ways, a million different ways. There's different ways that that money can potentially grow, different ways that you can potentially like take it out. But the idea in terms of tax savings is not necessarily to save you taxes right now. Like putting money into a life insurance policy is not like a tax deductible expense or anything like that. But as it grows over time, let's say it's like 15, 20, 25 years down the road, that cash value bucket, you can potentially take like a loan against the cash value bucket, and it's not a withdrawal, so it's not taxable. So some people say that you can use it very similar to like a post-tax retirement account because you can potentially get money out of it without paying taxes on it when you take that money out of it. But it is more complicated than that. And I think this is a very good example of maybe we're kind of trying to play this game of getting some tax advantages, but we're doing so in a very, very complicated way because the policies themselves are very complicated. How that money grows over time can be very complicated. And the other thing is that it's a huge commitment. You know, if you set up a policy with the target of funding it like $20,000 per year, and then you don't do that, it doesn't work. Like that policy can potentially just fall apart. You can like bankrupt the policy basically and make it so that it just doesn't work anymore. So you really have to set it up in a way that makes sense for you for a long period of time in order for it to play out anything close to what they project. And then if you don't, like it's just not going to work out well for you. So it's not very flexible. It's a big commitment. It's very complicated and kind of hard to understand. So sometimes we have clients that kind of have decided maybe to do this and then they want to get out of it later because they don't get it anymore, or maybe it made sense at the time that they set it up and maybe it doesn't make sense for them anymore, and it ends up potentially just being a big waste of money. Maybe we don't even get how much money out of it we put into it. Maybe you've actually lost money by setting up this life insurance policy. So that's one where it's like, okay, like it can potentially have some tax advantages. Be very clear about what you're getting into, and also like really, really understand how big of a commitment it is. Like that's a big part of it.
Yeah. I have some clients, like there's a handful off the top of my head that we've set this up for. It's used correctly and
Yep.
implemented correctly for the right purposes. And, they kind of use it as their own personal bank. Like when they need a chunk of change, they can borrow money at a below market interest rate. They're borrowing from themselves, so they don't have to pay it back if they don't want to. They could pay it back whenever they want to. Um, and it works quite well. Like we've used it for real estate purchases, for kind of bridge the gap between buying this house and selling my current house. Had someone use it for surrogacy related expenses and then gradually repaid it. Car loans, like had someone buy a car with it. Oh, interest rates on loans weren't that great, so I borrowed from my life insurance at like 4%, but it's 4% that gets
Is
more or
getting
less
credited
credited
back to the
back when
policy.
yeah, so it's
Yeah.
like a 0% interest rate loan, more or less. So yeah, if it's done, set up correctly and used for the right purposes, it can work great. But like Rachelle said, it's definitely a longer term strategy. You can't just set it up this year and change your mind next year because then it's just an expensive life insurance policy.
Yep, absolutely.
Let's see. Maybe we start or continue with real estate because that probably comes up with everyone we meet. Like, oh, I want to invest in real estate, or I heard I should invest in real estate because taxes, you can save on taxes by doing it. And potentially, yes and no. I think the big appeal from a tax standpoint with real estate is you can deduct all the expenses related to a rental property from the revenue generated from the rental property. You can also claim depreciation over a period of years on the property, which can help offset the expenses. So in a way, you can oftentimes offset all of your rental income and not have to pay taxes on that income. Um, Granted, with a lot of rental properties, though, people aren't really making a whole lot of money on them. Especially if you've bought it recently. Now, if you bought it in 2010, great, you're probably sitting pretty. But if it's something that's more recent, it's hard to generate positive cash flow. Now, one area where it piques people's interest is the accelerated depreciation or the bonus depreciation on short-term rentals, where it was extended as part of the One Big Beautiful Bill Act, where you can depreciate 100% of the property cost against your W-2 income in the first year. Now, there's some hoops you got to jump through and criteria that you got to meet in order to qualify for this, which we won't dive into today. But it's not just anyone can claim this. You got to check some boxes in order to do it. But if you meet the criteria, it can be pretty cool. Like, hey, I bought a rental property for $300,000 and I depreciated $300,000 off of my W-2 income. That's some pretty huge tax savings. Sounds great in theory, but by taking that deduction in year one, you're only really saving the taxes in year one. It's a lot of tax savings, don't get me wrong, but then you lose all that depreciation in subsequent years, and it's going to be harder to offset the rental income in subsequent years. And if your property is losing you money, meaning the expenses exceed the rental income, you can't deduct those losses from your W-2 income. It's really just that bonus year one deal. Like the rest of it can be used to offset other passive income sources, but not your active income. And besides, if we shouldn't pursue losing money to save on taxes, because like you'd be better off paying the taxes. Like if you lose $100, you save 40 in taxes, but you're still negative 60 at the end of the day. Versus if you
Yep.
made $100 and you pay 40 in taxes, you're positive 60 at the end of the day. So yeah, you're better off making money, all else being equal, than losing money. Um, but uh, but yeah, the with the rental properties, when you go to sell them, there's depreciation recapture. So you eventually have to pay taxes on that money. Now, if under I believe the structure, like the house itself, the tax rate, if internet and articles are correct, is capped at 25%. However, if you depreciate the value of like the appliances, et cetera, that is uncapped and taxed at your ordinary income rate. So it's not like you're just avoiding taxes. You're eventually paying taxes, albeit maybe at a lower rate than your normal ordinary income bracket. Um, and if you hold the property till death, you pass it on to your heirs with a step up in basis. So that's the real cheat code. Own the
Hmm.
property till you die. Um, but in normal people's goals and objectives, like if you can find that unicorn that's generating a lot of rental income, and you can save on some taxes, and great. But for most people, it's more headaches than it's worth, and the tax savings isn't as grand as they had hoped.
Hmm.
unless you bought a foreclosed property somewhere in 2009 to 2013, and then maybe you're sitting pretty,
Yep. But now you're a landlord.
which most people don't enjoy. And even if you
I know.
hire a property manager to do it, like most people are like, this kind of sucks. I don't like this.
Yeah. And some people are fine with it. I think that, there are the right people to do these kinds of things. Absolutely. I have one client who is doing it and like he's totally the right person for that strategy because he's like kind of dedicated to it and doing it repeatedly, like kind of like, okay, I did it once or twice and it was like a really good situation and I can replicate that and do it the same like multiple times and he enjoys it. It's like a second full-time job for him. I'm like, I don't know how you live, but cool. Like you actually seem to enjoy this and it's being executed well. But yeah, I obviously like this is going to be a lot more complicated than just paying taxes too. But yeah, I think I don't, Corey, you were already talking a little bit about Airbnbs or like short-term rentals and things like that. Sometimes people also want to buy a vacation home for themselves and then rent it out. And then there's a lot of like complicated tax things with that. Like how much are you renting it versus how much are you staying in it? Can you even actually treat it like a rental property on your taxes, depending on how much you're using it personally? And also, like, are you actually going to rent it out? Like maybe you're not. Like, maybe you just want to stay there, like let your friends stay there when they want to stay there. And so there's some execution issues there as well.
Yeah, I know a lot of people with that intent in mind are like, oh, when I'm not there, I'll Airbnb it and it'll pay for itself. And it's like, no, you probably won't. Or you'll get annoyed and stop renting it because like the tenants trash the place, or the week that you want to go, you realize you rented it and then you can't. And then you just end up not using it as much as you'd like and end up selling it one day. But I mean, sure, if you go in with the right expectations and execute it correctly, it could work out well. Um, but usually making your vacation home that you want to be on vacation at also a rental doesn't go well. Because there's lack of availability, and again, people aren't going to treat it like their own house and take care of it as
For
well.
sure. Yep.
Um, See, opportunity zone investments. So these don't really come up much with our clients. We've come across them a couple times, but if you purchase a property in a designated opportunity zone, you can exclude the capital gains from the sale proceeds if you hold the property at least 10 years. There's a few other perks there as well, but the reason that these tax incentives are offered is because typically these properties are in crummy areas and they may or may not appreciate it at all, and you may not even be able to sell them in the future if nobody wants them. The whole idea is, hey, let's try and generate some investment in these rundown areas of town, try and revitalize them, and maybe it'll work. Maybe that area will rebound and recover, and property values will grow, and you can avoid capital gains because you were one of the ones that helped spur that growth. But it may not work out that way. So you may
Hmm.
end up just having a dud of a property, and there's not really any appreciation to pay taxes on, anyways. So, um, not saying don't pursue them at all, but uh, proceed cautiously and do your due diligence.
Hmm. I've heard of some solar investment strategies as well, where you can potentially invest in like commercial solar projects. And the expectation is that you'll receive some tax incentives that are passed through to you as the investor. I don't, I think that these are generally kind of longer term strategies, or not necessarily long term, but you have to be invested for at least a year or 2 years or something like that. And it's generally like a pretty big chunk of money. So $100,000, $200,000. And you can supposedly have some very large tax savings, but you may or may not get that initial investment back. Like it depends on how the whole process goes and how the actual project goes itself. So, and you may not get profit on it either. Like, so you kind of like give up your money, potentially save some on taxes, maybe get your money back, maybe don't get your money back. So be very cautious about exploring those kinds of things and make sure you understand all the ins and outs. What's the timeline for when you can get your money back? what's the expectation of how much money you will get back. And then those expectations aren't guaranteed. So make sure you understand like what's the range of possibilities and things like that too. But
Yeah, I think any moving along here, but any overly complicated strategies proceed cautiously with. Like, and we've come
yeah,
across some silly ones over the years, and it's often these tax planning firms that, charge you lots of money to find loopholes in the tax code and utilize them to save you on taxes, but it's all involves like often setting up multiple companies or, you know, shuffling money from here to there and back again and trusts and different states and
yeah.
it just seems overwhelming. There's one that I remember where it was something like the person had an extra 200,000 a year that they wanted to invest, but they wanted to save on taxes, and a tax planner recommended that they fund 200,000 a year to a life insurance policy for the next 5 years. So, we talked about life insurance a minute ago. And then and that money would grow tax deferred. You build up the tax-free accumulation, and you have this bucket that you can tap into tax-free later on. And I think the 200,000 a year was like front loading the policy. I think it was a 5 or 7 pay. So like you fully pay it up in the first handful of years. Um, and then this is where it gets even more skeptical. But they said you're going to take out a loan, 200,000 a year, like from a bank, for the next 5 years, and you're going to then donate 200,000 a year to charity. So we're going to borrow money, donate it to charity to get the tax deduction, and fund 200,000 to this life insurance. So we're getting a tax deduction on 200,000 a year. We're growing 200,000, and then the charitable contribution, they changed the rules last year on what can be deducted. So it's not fully deductible anymore. So that's another thing to keep in mind. Like any of these rules, laws, etc., they can change. So you might be, pursuing this tax saving strategy and then the rug gets pulled out from under you. And if you've got it tied up in some illiquid assets, that makes it even more challenging to pivot. But yeah, like it was basically borrow money, fund life insurance, get tax deduction, and then somehow repay this life insurance loan over ensuing years. Um, and you have this tax-free life insurance bucket down the road, and you got the charitable tax deduction early on. I'm like, this sounds too complicated for you. And it sounds like it could easily backfire. And like, what if your job changes and you don't have 200,000 a year coming in to invest into this?
Yeah.
Um, so yeah, with anything that involves multiple years of strategy execution, again, things can change, your job can change, income can change, laws can change, rules can change, personal circumstances, you name it. Um, yeah, at another one where the client, was in a relationship and their partner had their own business, and the tax planner recommended all these strategies using the partner's business as kind of the the source to funnel everything through to get the deductions. And then like a year later, the partner took a W-2 job and closed the business. And it's like, well, there goes all those tax saving strategies. Uh, so yeah, it's again, you got to find that balance between complexity versus tax savings. And is it worth it to save a couple bucks in taxes? And how long is this actually going to work for?
Yep. Yeah, I think one other thing that we see with clients probably quite a bit is that they don't want to sell stock positions that they own, even if they're very, very concentrated. Like maybe we have 25% of our invested assets are in a single company or something like that. And they'd rather like kind of hold on to it and not pay taxes on those capital gains by selling and diversifying. And it's really like you're kind of avoiding these capital gains. But realistically, if we're paying taxes on capital gains, it's because we locked in those gains when they happened. And now, we've made that money at this point. And sometimes I feel like people would rather sell out of an investment when it's down a bunch. And then now we've locked in losses. So we've paid less in taxes, but we also made less money on that investment, which is like kind of crazy to think about too. So, I mean, if you're reinvesting it immediately and everything is down, maybe that's still an okay strategy. Like, if everything has kind of come down roughly equivalently, awesome. But that's not usually how the stock market works. Like, different companies are down different amounts. And if you have one very concentrated position, like sometimes those really big companies that kind of blow up over time, like they have bigger corrections sometimes than the rest of the index or something like that. So you just got to be cautious about like maybe it does make sense to hold on to that position, but try to think of that and taxes can be part of the consideration, but it shouldn't be the only consideration. You should also be asking yourself like does it make sense? Do I still have confidence in this company that's going to continue to go up over time? And you may not be right, but obviously like it matters what you think about that too. And just be cautious about holding like really concentrated positions like that.
Yeah, and statistically speaking, individual stocks underperform the market as a whole by about a third over time. It's the heavy hitters that carry the weight of the index and they change, from year to year, decade to decade. And I back in 2020, 2021, we were doing a decent amount of work with people at tech companies that were IPOing. It was the big IPO craze, and every company was going public, and all these late 20, early 30-year olds were sitting on a ton of monopoly
Multi-million
money.
dollar, like,
Yeah, in
yeah.
stock options. They didn't actually realize it until they exercised and sold, but on paper, it was, seven figures, sometimes eight figures for a lot of them. And not a single one of those stocks is worth more today than it was when they IPO'd. There are some companies that treaded some water for the last 5 years, but if people had just sold out of it 5, 6 years ago and invested in a
In an
diversified
index
index
fund,
fund, their
yeah.
money would be double what it is or what it
Yeah,
was. Instead, most of
yeah.
them saw their company stock slide 80, 90%. Um, and it's sure you might be at the next Google, but odds are you aren't. And
Hmm.
if you've, if there is a bite of the apple being offered to you, take it because you might not get another one.
Yeah, cash
So,
it in.
yeah. And, again, circumstances, find the balance, et cetera. Like maybe you don't sell every last penny, but if you've got stock options for you purchase for $3 and the stock's worth $100. All right, let's be happy that we made $97 a share and gladly pay some taxes and set our future up for success rather than
Yeah.
rolling the dice and trying to get greedy.
Yeah. The other thing that you can consider doing if you're really adamant about kind of holding on to those stock positions, you can buy options to kind of protect that holding. So, like, you pay a cost to do it, but you can basically like buy options that make it so that, if the price goes below a certain dollar amount, you have the option to sell it to someone at a fixed dollar amount. So you're like kind of protected on the downside. Those like expire after a while, so if you're going to hold on to your position for a long time, it's like maybe you have like a 6 month option in which you can do that, and if it goes down in that 6 month time frame you can sell it at that price point. But then you got to kind of renew those things over time if you want to continue to hold those positions. And obviously if they hold their value for a longer period of time, maybe that's less necessary, or feels less necessary. But there are some ways that you can potentially like protect your holdings if you wanted to explore that. But again, more complicated, and it costs money. It's not free. Yeah.
It's kind of like buying insurance on your
Yeah,
positions.
for sure. Hmm.
So, well, let's see. Now that we've talked about some head scratching and cautionary tax strategies, what are some smart ones? So, we don't want to
Hmm.
discount tax implications completely. Far from it. Let's be wise with our tax decisions, but let's not go overboard trying to save a couple bucks in taxes. Um, still rebalance your portfolio periodically, but we want to do it in a tax sensitive manner. So avoid selling for short term gains, meaning less than a year of holding, because short term gains are taxed as ordinary income versus long term gains are taxed at capital gains rates. Tax loss harvest in your taxable accounts. So if positions are down from where you bought them, you can sell those and losses offset gains for tax purposes, which is beneficial. You could consider direct indexing. It requires larger upfront initial investments, usually close to 100,000. or more, depending on the index you're replicating. But it can be a little bit more tax efficient way to essentially do what you're already doing, which is investing in a broadly diversified portfolio. I think we did a direct indexing episode a little while ago.
A while back, yeah.
Yeah, you could hold dividend paying positions in tax sheltered accounts like your IRAs and 401ks rather than your taxable accounts, um, and less income generating positions in taxable accounts because you're going to have to pay taxes on the dividends. So, we'd rather not do that if we don't have to. Municipal bonds, the interest paid on muni bonds is federally tax free, and then also tax free at the state level if it's a state specific bond that in the state that you live in. So if you're in a higher tax bracket, those can be handy in your taxable accounts, but they're not beneficial in tax sheltered accounts because those are already tax sheltered. You don't pay taxes on.
And the yield is usually lower. So it's like,
Yeah.
why would you do that? Yeah.
Exactly. And if you have a larger sum, like you could build a portfolio of individual municipal bonds rather than a fund. And sometimes you can generate a higher interest on those bonds than if you were just to buy a mutual fund of muni bonds. But again, you're going to need a little bit larger sum to do that. And then when you're in retirement, we want to be strategic when taking distributions, like a balance of pre-tax IRAs, Roth IRAs, taxable accounts. So we kind of balance it out, stay in those lower tax brackets, but living on more money than the tax bracket would indicate. So that's why we want to invest in different things like pre-tax accounts, Roth accounts, taxable accounts, et cetera, so that you have those options for distributions in retirement.
Yep. I had a client the other day mentioning that he was concerned about RMDs. Actually, I think it came from his parents. Like his parents are kind of concerned about RMDs, which are just like the required amounts that you have to take out of your pre-tax accounts when you're later in retirement. And he was like, I don't want to get stuck in a position where I have to take a bunch out of my pre-tax retirement accounts and pay large amounts of taxes because of these required distributions. And I was like, this is when you're 75. You have to take required distributions, not before, like not until you're 75. And until then, we have lots of time to plan. And so it may be that early on in retirement, we're doing Roth conversions or something like that. While your income is lower, maybe we're taking some of that IRA money and moving it into the Roth account so that your RMD requirements are a little bit lower because you have less in your pre-tax accounts at age 75. But those are the kinds of things that, yes, we should be aware of and consider, but also there's a lot of time to plan. And if you're doing some active planning, it'll be fine. Like, boo-hoo, you have too much money and you have to take out a lot from your retirement accounts. It will be okay.
Yeah, that's kind of, I always tell myself about taxes and remind clients as well. Like, if you're paying a lot in taxes, it means you're making a lot of money. So that's a good thing. And be happy about that. So,
about the money you're making, even if you're not necessarily happy about the taxes you're paying. Yeah.
Yeah. And I mean, I like roads to drive on and police officers and firefighters and clean water and whatnot.
Schools.
Schools are good, educating our children. So yeah, I mean, I'm sure everyone has opinions on where money could be better spent in their local community or at a national level. But yeah, it's death and taxes. There's no way to avoid it completely.
Yeah. Awesome. Well, thank you for listening, everyone.
We'll see you next time.